This is a news-oriented broadcast, and all information is educational in nature, is not intended to be legal, securities, tax, or insurance advice. Securities are not offered or sold on the show. Please consult with the appropriate professional before acting on information heard during the broadcast.
Advisory services offered through Adjemi Wealth Advisors, LLC, a registered investment advisory and fiduciary to its clients. Adjemi Financial Strategies, Inc. and Adjemi Wealth Advisors, LLC are related.
Americans are worried they won't have enough saved for retirement now more than ever.
Retirement is going to cost, for many folks, over $1 million.
We got here because we made a lot of promises that we cannot afford.
There are things I'm hearing about now, fees and taxes, that I never heard of before.
This is shaping up to be a disaster.
Welcome to Financial Strategies with Andrew and Daniel Adjemi, powered by the Retirement Income Store. Over the next hour, be prepared to hear ideas, concepts, and strategies that may challenge the way you were taught to think about saving and investing for retirement. It's time to roll up our sleeves and get to it. Now, here's this week's Financial Strategies with your hosts, Andrew and Daniel Adjemi.
All right, so I get asked a lot, what does the current market situation most resemble in history? And not that I was around back then, but I think it most resembles the panic of 1907. Basically, what was happening in 1907 was we had a catalyst of earthquakes in San Francisco. Now, the earthquakes happened, which disrupted the water lines. And people were covered for fire insurance, but they weren't covered for earthquake insurance. So houses were burning down. And you can imagine if those were burning down because the earthquake did the damage or people were trying to collect insurance money on their houses that previously had damage from the earthquakes. This was all going on at the same time that President Roosevelt was trying to break up big trusts like Standard Oil. Does any of this sound familiar for what's going on? Basically, what happened was there were these financial trusts that had been set up and people didn't understand the risk behind them. They were basically a mix between a hedge fund in current day and a savings and loan. They took the negative parts of a hedge fund, the negative parts of a savings and loan, mixed it together, used up a lot of leverage. And that's where people were storing their money instead of a bank because they offered better interest rates. Now, we didn't understand back then the risk that these trusts had until the catalyst of the earthquakes, the fires, the breaking up of these big company trusts came into play. And basically, what saved the whole financial system from falling apart was Mr. J.P. Morgan. And the Fed wasn't in place at that time, and there wasn't federal deposit insurance at that time. So there was panic and people were going to these trusts into the banks and having runs on the bank. Well, J.P. Morgan, the man, came in and he pulled all the bankers together and said, we have to save the financial system. And basically, after that, they decided one man shouldn't have that much power. And that's partly where the Fed came in. I'm Daniel Adjemi.
And I'm Andrew Adjemi, and you're listening to Financial Strategies with Andrew and Daniel Adjemi, because people don't know what they don't know. Glad to have you back for our radio show today. And our theme for today is Thank You, Mr. Powell. And Daniel started with an illustration of history in 1907, what happened in the market. Daniel, what does that mean to us today? So you told us how basically the concept of where the Fed came from, and what does the Fed do for us today? Mr. Jerome Powell is the head of the Fed currently. What are they doing for us? Is it even a governmental organization?
So back in 1907, there was all these uncertainties, and the New York Times had come out and said, we don't know how to evaluate stocks. There's stuff being broke up. There's trust being broken up. We don't know how to evaluate things. There's all this fear. But even before that happened was JP Morgan pulled these banks together to save the system. So back in March, the system fell apart. And basically what happened was Jerome Powell stepped in and said, we are here for the markets. We're going to set up swap lines. We're going to fix the liquidity problems in the market. and we will loan money to these big organizations so they don't have to go bankrupt. Then they said, we're going to buy bond ETFs, we're going to buy treasuries, we're even going to go into the junk bond ETFs and buy those. Because the Fed is so large and powerful, this fixed the liquidity problem just by him saying that. And what happened was corporations were actually able to go into the debt markets and issue their own debt because the liquidity problem was fixed. And that's how our markets have been able to come back to where they are now.
Well, thank you, Daniel. And with that, with what you're talking about, Daniel, and the history of the stock market and what's going on, a lot of people don't understand the cycles that the stock market goes through. They don't understand that there's repeatable trends. And to our listeners today, we have a white paper that we'd like to offer you called The Hard Lessons Learned in the Stock Market History. Hard lessons learned in the stock market history. Well, we'd like to give you that paper, and if you call us at 800-725-7616, we'll be glad to get that to you. That's 800-725-7616. You're listening to Financial Strategies with Andrew and Daniel Adjemi, because people don't know what people don't know. Daniel, the aspect of the Fed, the Fed is not even a governmental organization. A lot of people think that the Federal Reserve is a government organization. It's a private organization. It's not a government organization, but it has a lot of bearing upon what's going on in the world and in this country. One of the things that they're supposed to be doing is to help the economy, but they end up getting involved very much in driving the stock market instead of driving the economy. A good example is that they were very much involved in 2008, 2009 in the stock market, but the economy was terrible in those years and even for a few years after that, but the market was kind of more booming from that standpoint. Now, this is part of what the government has put in place to help us with this, and Jerome Powell is the head of it. But my understanding is, like what you're saying, Dan, you're talking about the catalyst, the problem, the thing that starts the problem has been all these things going on that you're relating to today. And as we look at that and talk about that, what's going to be happening here with, what about all these riots going on? A protest is what Martin Luther King did, and those pictures we've seen of him being arm in arm with people walking, straight across. But, what's going on right now is really rioting more than protest. But anyway, why do you think this stuff is going on right now? Are people angry or what?
Well, yeah, I think there is injustice in the system, and the peaceful protesters are doing a good job. The rioters have a totally different mindset, and again, it reminds you there's cities burning down just like there was back in 1907. So there's so many similarities. The earthquake, coronavirus, right? There's a catalyst. Back in 1907, the earthquake was a catalyst, but the underlying issue was these financial trusts that had a lot of leverage, and people didn't understand that. They thought they were just making money without taking any risk. And what we've learned from history is typically there's a catalyst that shows us the underlying risk. Have we seen an underlying risk yet? You talked about protesters and you talked about rioters. What is an issue? Well, an issue is that corporations have made record profits for the last few years, yet employees have not received benefits from that. Stock investors have, because corporations have been doing corporate buybacks, but employees haven't. And this is an unrest that has been building up and building up. And that could be one catalyst.
All right. And so you're saying that, we had this coronavirus, which was a catalyst for what brought about the drop in the stock market in March and so forth. And back in 1920, or actually the late teens there, 100 years ago, we had, wasn't it the Spanish flu? That was a similar kind of epidemic that went on in this country. And we have these external catalysts that create a financial difficulty in the markets. sometimes, not always.
Right.
Because there's been a lot of epidemics over the years that have not created problems in the stock market. But this is one of those cases it was. And when you're talking about 1907, we had the earthquakes. Again, external, nothing having to do with finances, an external thing that affected the markets. And the same way in 2001 with 9/11, that was an external thing, nothing to do with the markets, but it affected the markets greatly. And that, of course, that was the plan of those people that were involved with that. But nevertheless, we have these externals create this catalyst, and that's what's been happening. People are angry now. They've been cooped up inside for months and months and months, and the market is going up, and the rich are getting richer. There's so many people that are unemployed currently, tens of millions of people unemployed, and sure, they're getting more money than usual from unemployment because the government's giving them $600 a week besides their unemployment, but that's not going to last. That's not going to be good. Whereas those people who have had their jobs, considered to be the rich are getting richer because their money is back as the market is up and it's moving forward. Do you agree with that estimate and that view of what's happening?
Yeah, there's this divide between the markets rising and the rich getting richer, and the people who are then left behind are getting angry, and they are becoming even more left behind. The hurt are being hurt even more. And that's where we see the economy going one way. Although we did see some hope. We did see some hope with the job reports. But we're still at a historically low number, between 13 and 15% unemployment. Now, to put that in perspective, back in the great financial crisis, it was about 10% unemployment. And so you see this divide happening, and the Fed is able to help the financial markets by fixing the liquidity problems. But we have more systemic problems that have not been addressed. And what you have to ask yourself is, how will this systemic unrest affect the market as it reaches new highs?
Oh, that's a great question. And we're going to take our first break here. And, with all these things that we're talking about, we'll answer that when we get back, right, Daniel? Is how will all these things going on affect the stock market as we go forward? And one of the things we need to understand is that if you don't know history, you're doomed to repeat history. So today for our listeners, we have the white paper called Hard Lessons Learned in the Stock Market History. So we must understand stock market history to not make the same mistakes that has happened in the past, or at least be able to learn from those mistakes that others have made and be able to not make those same mistakes going forward. So if you'd like that white paper, Hard Lessons Learned in Stock Market History, call 800-725-7616. You're listening to Financial Strategies with Andrew and Daniel Adjemi, because people don't know what people don't know. And with that today, if you'll go to our website, Adjemi.com, that's AGEMY.com, the two words AgeMy, spell Adjemi. And you can also request that white paper there as well. We also like to give away to our listeners a book that's talking about some of these things. And if you're so inclined to read, this is a very easy read book, 100 pages written by a friend and one of my partners, David Scranton, called Financial Insanity. Certainly it's what's going on in the world today and in the markets today. And even though the book was written in 2011, it still is very pertinent today. A lot of good information in this book. I mean, if you're a slow reader, you're going to be able to read it in less than 3 hours. So if you'd like to have this book, Financial Insanity, please call 800-725-7616. Again, you're listening to Financial Strategies with Andrew and Daniel Adjemi.
You're locked on to Financial Strategies with Andrew and Daniel Adjemi, powered by the Retirement Income Store.
After a certain age, you shouldn't be overexposed to stock market risk. Yet, you might still be trying to squeeze every last drop out of today's market. And although fixed income investment can offer less risk than stocks, it doesn't mean you have to sacrifice return. In fact, recently, some fixed income investments have actually outperformed stocks. But yet, you're still waiting to act.
To learn more about the Retirement Income Store, call your local Retirement Income Specialist.
Adjemi Financial Strategies at 800-725-7616. That's 800-725-7616. Or visit us online at Adjemi.com. That's AGEMY.com. The Retirement Income Store. where retirees go for income.
Investing in the stock market these days is like riding a roller coaster. 1 minute you're moving up slow and steady just the way you like it, and then all of a sudden, your investment portfolio is in a free fall, up 800 points, down 800 points. It can be very scary. A lot of people no longer gamble with their retirement in the stock market. If you are tired of the ride and want to look at safer options or would like to learn a better way to grow your money during these times,
call Ajami Financial Strategies at 800-725-7616. That's 800-725-7616. Or visit us online at ajami.com. That's AGEMY.com. Time now for more of Financial Strategies with Andrew and Daniel Ajami, powered by the Retirement Income Store.
In 1987, Matt invested tens of thousands of dollars in the market. This is at the beginning of 1987. Well, on Black Monday of October 1987, the market dropped 500 points. Why was that such a big deal? Well, that was 25% of the stock market. Matt lost a lot of money, tens of thousands of dollars as well. So Matt pulled out of the stock market. When Matt pulled out of the stock market, you couldn't pull him back into the stock market with a team of wild horses. You know, that's much like what happened with people in the Great Depression, where they experienced the drop in the stock market, and it would be very difficult to pull them back in, for the most part, into the stock market and try to get them to invest. And Matt would not do that. As a result, Matt lost all of the gains that were attributed to the balance of the 80s and into the 90s, the two best decades in stock market history. And as far as I know, never got back in because of that experience that he had with the stock market. I'm Andrew Ajami.
And I'm Daniel Ajami, and you're listening to Financial Strategies. So why are you bringing up this story about Matt?
Well, because 1987 was a time that the stock market dropped, and we think of it in our minds at this point because we have short memories. We think of it as was just a blip on the screen, but it lasted almost 2 years before the market came back to where the market was. And with that, once it came back, well, boom, it took off, and we know that the market just went crazy after that for the next 10, 12 years, whatever it may be. But he lost money. He didn't want to get back into the market. And one of my big points behind that is, you see, people's first experiences with something tend to dictate how they think about that in the future. And a lot of baby boomers have had a phenomenal experience and love affair with the stock market. They've been enamored with the stock market. Because in 1980, the stock market, the Dow was at 700. By the time 2000 came, the Dow was at 11,700, Daniel. It had grown 17-fold. And so that's when a lot of baby boomers got into the market, because they got into the workforce around that time in the 80s, and all of them were in the workforce making a lot of money. And they were driving the market up because they were having babies, buying houses, buying cars, and that makes the market go up. Plus, they were investing. And it was about that time in the 80s when pension plans started going away. And when they started going away, they came up with 401k plans. So now people have all this money that they're making, and they have to put it somewhere. So they put it in their 401ks. They put it in the stock market, and the market goes up and goes up because it's the supply and demand. So they were very enamored with the market. Now that baby boomers are getting to retirement age, 2000 was the end of the long-term secular bull cycle, that people think that it's going to keep continuing because that's what their experience has been. Their first experience with the market was good, so they think it's always going to be good. But that's not necessarily the case, is it, Daniel? I mean, tell us what happened in 1921 and your view. What happened in 1987? Why did it drop 25%?
Well, there's typically a catalyst that causes it. There was some unrest in some different areas, but what was misunderstood? So there's a catalyst that triggers something. 9/11 triggered the tech bubble. 9/11 wasn't the systemic risk that was in the market. That just triggered it, and then it allowed us to see what the underlying issue was. And that was evaluations of companies. There was all these .com companies that weren't making any profits, yet they were going to the moon as far as stock price goes. And that triggered the wake up, the reality. Oh, we're buying hope. We're not buying earnings. We're not buying corporate profits. We're not buying
promises or guarantees, right? Far from that.
We're not buying promises or guarantees. It was really one of the biggest bubbles we have seen. The NASDAQ had crashed, 80% in the 2000s?
Right. Well, and that's why it's so important for people to be able to understand stock market history so they don't make the same mistakes that others have made in the past, and that they can learn from it and change in the future. And, today's show is called Thank You, Mr. Powell, because Mr. Powell has put a Band-Aid on things at this point in time, so to speak, in my opinion, has made it possible for their portfolios to come back so that they can readjust. And we'll talk about that. But what I want to do is give people an opportunity to get the white paper, Hard Lessons Learned from Stock Market History. And we want to give you that white paper. Call 800-725-7616 to get that, or go to our website, agemy.com, AGEMY. I'm Andrew Agemy, along with Daniel Agemy, and today's show is called Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. So, Daniel, you were saying that these things were happening in regard to that. I talked with a gentleman yesterday, as a matter of fact. I'm going to call him Jim. Jim is 53 years old, and I started a conversation. I never talked to Jim before. I started and asking him how his day was. He said, my day is going great. The stock market is back, and my money is back, and so I'm really happy. And I said, well, what's your biggest concern at this point, Jim? And he said, my biggest concern is that, I'm 53 years old, and for the next 10 years or so, I want to make sure that my assets, now that they're back, are going to be positioned properly to take me into the future and into the retirement, so that I can have the retirement that I've been planning on having. Because I recognize after this drop in the market that my money could go away, could flee very quickly here. So then Jim and I spoke about how he could change his allocation. And in his case, he said he was set up in a 60-40 mix, 60% stock and 40% bonds is what he said. And after asking him a few questions, I was able to discern that he actually was 60% in stocks or stock funds and 40% in bond funds. And bond funds, Danielle, you've taken the financial advisory test. And one of those questions on there is, what's the definition of a bond fund? The government gives us these tests to be financial advisors and fiduciaries, and with that, the answer on that test is what?
Owning stock in a company that buys bonds.
Yes. Stock of a company that owns bonds and buys bonds. That's exactly right. Because it's the ability to hold them to maturity. So if you're investing in bond funds in your 401k or with your financial advisor, you're not that much less risk than the stock funds you're in. Please beware of this and be educated. That's why we have financial strategies, and we have this show is to educate people in what they don't know, because people don't know what they don't know, and we want them to know and to learn what they don't know. That's why we're coming to you today to bringing you this information.
So why are we thanking Mr. Powell?
Well, Mr. Powell has done some things to be able to turn the market around and make it come back up. And of course, people are optimistic overall to be able to want the stock market to go up, and they do what they can to make it. But my concern, Daniel, is, do you share this with me? This concern that the market is kind of like a game of musical chairs. And when the music stops, people are going to be without a chair. They're going to lose money.
I think that's a good possibility. When, the Fed came out and they basically said, we're going to do whatever it takes, they fixed the liquidity problems in the market. And what that means is basically the back ends of the market where there's money trading back and forth had dried up, and it really caused some certain tremendous problems in the financial markets. When the Fed said that, they didn't even have to start doing the purchases they promised, because people gained confidence. And what it allowed to happen was it allowed corporations to start issuing debt again, which gives them the ability to stay in business while we're fighting the coronavirus and cash flows are negative. So it gave them the ability to generate that on balance sheet cash to keep going. And the Fed didn't actually have to do too much of support because they're so powerful. Them saying these words, we'll do whatever it takes, gave investors confidence again.
All right. We're coming up to a time when we have to take a break here. So you're listening to Financial Strategies with Andrew and Daniel Adjemi, because people don't know what people don't know. We're giving away a white paper today called Hard Lessons Learned in Stock Market History. Hard Lessons Learned in Stock Market History. Also, we're giving away a book written by my friend and partner, David Scranton, Financial Insanity, which will also give you some insights in a little bit more layman's terms so that you can understand the things that we're relating to today and talking about today. If you want those, either that white paper or that book, please call 800-725-7616. That's 800-725-7616, or log on to agemy.com, AGEMY.com. And in the comments there, ask for either that book or that white paper. Just say Stock Market History or Financial Insanity. You're listening to Financial Strategies with Andrew and Daniel Adjemi. Stay tuned.
This is Financial Strategies with Andrew and Daniel Adjemi, powered by the Retirement Income Store. Welcome back to Financial Strategies with Andrew and Daniel Adjemi, powered by the Retirement Income Store.
Daniel, 2 weeks ago today, I cut my hand. I sliced it with a razor knife, and very deep. But I don't necessarily like going to the hospital. You know, my mother was a registered nurse and taught me a lot about how to handle these kinds of wounds and so forth. So I wrapped it up, basically put a big Band-Aid on that wound, and it stopped bleeding. I went home. I took the Band-Aid off. When I took the Band-Aid off, it started bleeding again. I put some super glue on it and wrapped it up again and stopped the bleeding. But then the super glue came off when my hands got kind of sweaty and so forth, and the super glue came off, and it had stopped bleeding at that point, but could very easily start to bleed again from just putting these Band-Aids on. And I had to do some work to that wound to actually get it to heal. And, you know, today I gotta say it's probably 95% healed today as a result of that. And I'm pretty happy about that. That is my Band-Aid story. I'm Andrew Adjemi.
And I'm Daniel Adjemi, and you're listening to Financial Strategies. Your Band-Aid story kind of reminds me a little bit about what's going on in these financial markets. You know, we had a catalyst, which was, you know, this coronavirus, and the Fed was able to put a Band-Aid on that. You know, the federal government, not the Federal Reserve, was able to help with that as well, allowing so, you know, students don't have to pay their student loans. You don't have to pay mortgages. There's all these provisions. We have unemployment going. So we put a Band-Aid on this, and it's helped drive the market up. You know, you have to ask yourself, when people start having to pay student loans, when people start having to pay their mortgages, when unemployment, this additional unemployment insurance stops, what's going to happen? Is this a Band-Aid, or corporate earnings going to go back to the historical numbers they were before all of this started?
So we're saying thank you, Mr. Powell, because it's like he's the one that put the Band-Aid on. I mean, you said we put a Band-Aid on. When you say we, I think you're meaning Mr. Powell, correct? By the things that he did?
He fixed the financial markets with the power, so people have faith in the markets again because the Fed is buying it. And I'm sure you've heard, you know, don't fight the Fed. So we have all these people throwing their money into the market because if the Fed's buying it, we should be buying it too.
Right. But it's just a temporary fix. It's not a long-term solution to the underlying risk that we don't even know about's happening, but we do know. We always find out about the risk after the fact, later on down the road. But the problem with this is that this could affect people's retirements. It could drive their retirements into the pit if they're not careful with that. Isn't that what we're trying to bring across today? That people need to be able to manage the risks that are out there properly?
Yeah, so with the uncertainties, kind of like back in 1907 with Roosevelt breaking up the trust companies and having a hard time valuing companies. That's Warren Buffett's thought on it right now. In his shareholder meeting, he said he sees fundamental changes in our country where companies, especially he was talking about the airlines, won't be as profitable. And he's been selling out of stocks as the Fed has been encouraging people to invest into the markets. Why do you think Warren Buffett, one of the best investors of all time, is holding more and more cash instead of less and less cash? He didn't purchase anything in that dip back in March.
Well, he must know something that most people don't know. It sounds like he's doing things differently than most people are right now.
So if we have catalysts and then we have a systemic risk or an underlying cause, an underlying misunderstood financial product, which if we look back in history, we've seen again and again, then we may have not seen the worst of everything because we haven't found out about, how corporations are going to have cash flows going forward, how we're going to hire people when people aren't spending money like they were at the beginning of the year.
Yeah, right. It's a very interesting aspect about what's going on and, the things that are going on. You mentioned, and we've been talking today about these different times in the stock market, with 1907, 1921, 1987, 1999, and throughout, Wall Street keeps creating products that have great ideas, but then they get out of hand quickly. And we don't find out about them getting out of hand until after they've gotten out of hand and the music stops. And then there's certain people that are without a seat. And unfortunately, when it comes to retirement planning, most people can't afford to be without a seat. In 2008, 2009, some people had to go back to work or not be able to retire because of what happened there and how their money was invested.
Well, that doesn't sound like any fun to me to have to go back to work after I've already retired or put it off. I mean, you work 40 years and it's time to enjoy retirement and not have to worry about, Wall Street creating some crazy thing that people don't understand and gets out of hand, like the portfolio insurance in 1987 or, mortgage-backed securities, COLs, or credit default swaps in the late 2000s.
Right. And people don't realize that there's these old tried and true investments that are bond and bond-like instruments that have been around for decades and decades. And especially in the 50s, the 60s, and the 70s, that's what people did. That's what their parents invested in. But that gives them some income as well as growth. But most people are investing in more growth-oriented. Maybe they have a little bit of income, but mostly more growth-oriented. And people don't understand there's a universe of options other than the stock market that they can invest in to be able to protect their monies, but still have growth. And that's where people need to be able to reallocate and take this opportunity that Mr. Powell has created by putting a Band-Aid on the market to be able to reallocate their monies into a portfolio mix that is going to be more conducive to their retirement and to them retirement. Daniel, that's why I always say at AGME Financial Strategies, our company, that's why I say that we help people retire every day. We help people retire and stay retired every day because our clients don't have to worry about if they're going to be able to retire or not. Many of them, Daniel, as you know, are investing in contractual investments that we know what they're going to produce and when they're going to produce it so that they'll be able to have the retirement lifestyle, the income that they need. Some of our clients have more income when they retire than they did before they retired. How about that? How does that make you feel, Daniel, if you were able to have more income in retirement than before you retired?
I think I would love that. I mean, how can you have too much income? That reminds me a little bit about something you said on last week's show, that equation you used, which was, I think you said I plus G equals TR. What does that mean?
That's an excellent question. I see it's time I just want to offer our audience and let them know who we are. We're Andrew and Daniel AGME on Financial Strategies because people don't know what people don't know. Daniel's my son, and we're partners in our firm that's been around for 30 years, AGME Financial Strategies, with offices in Denver, Colorado, as well as the main office in Guilford, Connecticut, outside New Haven, Connecticut, helping people retire and stay retired every day. Today, we're giving away a white paper called Market Math Made Simple. A lot of the things that we're talking about today, to some people might think they're kind of esoteric and high view of things and whatnot, but this Market Math Made Simple is just a short white paper that if you'd like it, we'd be glad to give it to you, along with a video book. I don't know if you've ever seen these animated video books, about 4 to 7 minutes long, called The 7 Risks of Retirement. And as you approach retirement, if you're 10 years or closer to retirement or in retirement, you may want to get this video book or this white paper to be able to take advantage and be able to learn some things that you may not be aware of, because Wall Street doesn't want you to know some of the things that we're talking about on this show. If you want either that white paper, Market Math Made Simple, or 7 Risks to Retirement, please call 800-725-7616, 800-725-7616, or you can log on to agemy.com, agemy.com, or you can email us at office@agemy.com. The 2 words AGEMY spell our last name of Agemy. Ask for either the video book called 7 Risks of Retirement. You can just say 7 Risks, or you can ask for the white paper that's Market Math Made Simple. All right? Excellent. You're listening to Financial Strategies with Daniel and Andrew Agemy, because people don't know what people don't know. So Daniel, you asked me before about what is this TR equals I plus G? Well, total return, when somebody is wondering about what percentage of return they've got, or they look at their 401k statements and it says, oh, your return for this period is, and if it says 10%, well, that's the total return. And the total return equals I plus G. So income plus growth is where you get your total return from. So the quick example of that is if you had a CD paying 10%, that's all interest. So your total return is 10%, but the 10% is underneath the I column, the interest or the income column. Whereas if you buy Tesla stock and it went up 10%, went up from $300 a share to $330 a share, or from $900 a share to $990 a share, then it's all underneath the growth column. But if you bought the S&P 500 and you're getting maybe a 7 or 8% total return, and 2 or 3 of that is under the I column, 5 or 6 of that's underneath the growth column, and you can have some growth and interest or income. But the problem with the S&P 500, Daniel, is you're only getting 2 or 3%. If you got $1 million, you're only getting $20,000 or $30,000 of dividends every year on $1 million. And that's not a lot of money, generally speaking.
So are you saying that we can take this present that Mr. Powell and the Fed have given us, basically getting the markets almost back to where they were, maybe taking our profits and looking at some of these other kinds of options where we don't have to worry about the volatility and we can collect? Now, you said we have clients that have more income than they need. And so if they have more income than they need, then that equals growth, doesn't it?
Well, if you have more income than you need, exactly, we can invest that income, reinvest that income, and then it adds to the overall portfolio. But if you need it, you can take it. So what I like to talk about is the chickens and the eggs. So one thing we know about chickens, they can get fatter, they can get skinnier, but they always do what, Daniel?
They always lay eggs.
They always lay eggs, exactly. And if you don't need those eggs, we're going to take those eggs, Daniel. We're going to buy more chickens with them. When we buy more chickens, what do we get?
More eggs.
Exactly. But if you need the eggs, we want people to live on eggs in retirement, not chickens. Because if they eat their chickens, they're eating the golden goose that's laying the golden eggs. And you know, people investing in the aggressive aspect of the stock market, we're in more of a growth model with little to no interest or dividends. They're buying roosters. And roosters don't lay eggs. They get fatter, they get skinnier, and they die. But they don't lay eggs. Whereas chickens, they're a renewable resource.
So we can look at the present that the Fed has given us, that Jay Powell has given us, and we can look at basically getting out of the market before we find out what that underlying risk that we've seen over and over again is.
Exactly. Yes.
And go to maybe if we're in retirement, something that can give us the income we need. And then if we don't need that income, we can organically, like those chickens and eggs, grow our portfolios and still make money.
That's right, Daniel. There's no reason to put your principal, your retirement at risk because you're afraid of not making any money.
I like how that sounds.
Yeah, you can still make money at the same time of protecting your retirement. Isn't that a fantastic way to go? But, people don't know this, Daniel. That's why we have this show.
This sounds like something every investor, especially every retiree, should know about. Why don't people know about this?
Well, there's two kinds of people out there. There's people that don't know what they don't know, and they don't want to know. But then there's people that don't know, but they want to know. And that's why the people listening to this show are those people. They don't know what they don't know, but they want to know. And so I'm glad that they're listening. And we're going to have to take a break right now. We'll come back and we'll talk more about that after the break. But I want to let you know that you're listening to Financial Strategies with Andrew and Daniel Adjemi, because people don't know what people don't know. And we're giving away the white paper today, Market Math Made Simple. And we're giving away the animated video booklet, 7 Risks of Retirement. If you want either of those, call 800-725-7616, 800-725-7616, or go to our website, Adjemi, AGEMY.com, and request it there. Again, our last name spelled with the 2 words, AgeMy. Go to Adjemi.com, AgeMy.com, and be able to request those things. And we'll be back in a moment.
You're listening to Financial Strategies with Andrew and Daniel Adjemi, powered by the Retirement Income Store.
The world has changed. Our economy has changed, and many things are going virtual. Meetings, school, shopping, even weddings. But your retirement is not virtual. It's real. With real food, healthcare, and other monthly bills that don't accept virtual money, like mutual funds and stock certificates. To keep you informed and up to date, Adjemi Financial Strategies has put together a series of webinar events. Our next webinar series is Savvy Social Security Planning, and our next event happens June 16th at 6 p.m. Eastern and June 24th at 4 p.m. Eastern. We also have a series of webinars coming up on required minimum distributions in the new world. And those dates are June 17th at 5 p.m. Eastern, June 25th at 5 p.m. Eastern, and June 30th at 6 p.m. Eastern. To register for our free webinar events, go to our website, Adjemi.com. That's AGEMY.com, or call 800-725-7616. That's 800-725-7616. Make plans now to join us for our next webinar event.
Have you missed any of today's program? No problem. You can hear all of our shows online anytime, 24/7 at Adjemi.com. That's AGEMY.com. Time now for more of Financial Strategies with Andrew and Daniel Adjemi, powered by the Retirement Income Store.
And we're back. This is Daniel Adjemi.
And I'm Andrew Adjemi, and you're listening to Financial Strategies with Andrew and Daniel Adjemi, because people don't know what people don't know. Daniel, earlier in the show, a few moments ago, I talked about Peter and Mary going to the casino, and they both grew their money, their $10,000. They both doubled it to $20,000. The difference between the two was what they did with the $20,000 and their mindset and their strategy that they used once they created the $20,000. Peter continued in the same strategy, the same risk that he was, and lost 75% of it, where Mary reallocated her money. She took the profits off the table. She took her money off the table and was able then to go home, put it in the bank, and do something different with it, and made it. Because the whole aspect about investing is buy low, sell high. Mary did exactly that. She bought low, she risked the money, she gained money, and she sold it while it was high. Peter, he bought low, but he sold lower. He does what most retail investors do. This illustration that I just gave of Peter and Mary at the casino is much like what's happening with people in the stock market today. There are some people that are totally enamored with the market and they're going to keep going in the market. Now, before the break, Daniel, you asked me, why don't people know what they don't know? And the unfortunate thing is that the talking heads in the world today, I'll just keep it at that, and Wall Street's intent is to make money, just like any business. But Daniel, how many directions does the stock market go?
Well, it goes up and it goes down and it goes sideways.
Exactly. It goes 3 directions, up, down, and sideways. Now, does Wall Street make money when the market goes up, Daniel?
Oh, they definitely make money when the market goes up.
Does Wall Street make money when the market goes down?
They do, even if it goes down.
Now, does Wall Street make money when the market goes sideways, Daniel?
Wall Street makes money when it goes every direction.
Exactly. Now, Daniel, when does a normal investor make money? Which directions do the stock market have to go in order for them to make money, generally speaking, for most investors today?
Well, for most investors, we need it to go up.
All right, because they're growth oriented and that's the only direction that they can make money. They don't make money when the market goes down. They might make some if it goes sideways, but not typically very much from that standpoint. And a lot of people don't realize in the past 5 years, the stock market has gone sideways for over 3 years in the past 5 years. People don't realize that, but it's been just crazy. But Wall Street's intent is to have as much of people's money in the market for as long as they can have it because they make money off of it. They're typically running by a suitability standard, a sales standard, whatever they can sell people. And it's a buyer beware situation. Whereas as fiduciaries, you and I, Daniel, have to make sure that we do what's in the best interest of the clients that we serve. And that's why we're trying to educate people with this radio program regarding what they don't know so that they can make smart, educated decisions. But people today have that opportunity, and that's why we called the show Thank You, Mr. Powell, because he's given everybody an opportunity to do what Mary did, to take the profits off the table, to sell while the market is high. Do you agree with that?
Yeah, I think that makes a lot of sense, that we're right here, we have our gains. Mr. Powell and the Fed have gotten us back basically to even, so we could take profits, and retirees should think about taking those profits and switching the allocation, keeping your gains and going in to the right type of investment vehicles that you can count on instead of hoping that will continue to go up on here. What drives markets?
Fundamentals, fear and greed, emotions, these kinds of things, supply and demand drive the markets.
That's right. And so we see a lot of fear of coming inflation because of the money being printed. We see a lot of fear of missing out on this recovery. But the fundamentals, there's still that big question mark on the fundamentals because corporations are not projecting what kind of cash flows they'll have. They're not projecting future incomes. And we don't know how the economy will reopen. So there's this disconnect between the fundamentals and the fear.
But what should people do, Daniel?
Well, like in your analogy, maybe you need to look at taking some of those gains and reallocating.
Well, but there's no place to reallocate to. All there is the bank and the stock market, right? You can't invest in bonds. And I'm being facetious when I say that because that's what I always hear from people because people don't know what they don't know, Daniel.
What if there was a way that you could participate in market gains but not have to worry about the downfalls? What if there was a way where you could organically grow your portfolio?
Yeah, that'd be fantastic. Especially if I could get 25, 30% of market gains and no losses, I'd be tickled pink with that. You don't have to make a lot of money if you don't lose anything.
Yeah, that's a strategy that a lot of our clients like to use. And they get really excited about that potential where you can basically cash out of the market but not have to give up potential if it does continue to rise.
That sounds fantastic to me. And We're saying thank you to Mr. Powell today because he's put a Band-Aid on the markets, on their economy, helping it to go up. We believe it's just for a period of time until the underlying risk is shown to us, something that becomes more difficult. But this gives people an opportunity to rebalance, to reallocate, to change their strategies from a growth or accumulation mindset to an income or distribution mindset as they approach retirement. We're not talking to the 30, 40-year-old today as much as we're talking about the 50 to 60 to 70 to 80-year-old today. Folks, we appreciate you listening to Financial Strategies with Andrew and Daniel Adjemi because people don't know what people don't know. Now, today we've been giving away the 2 white papers, Stock Market History and Market Math Made Simple. We're giving away a hard copy book of Financial Insanity by David Scranton, and we're giving away an animated video book for those that like videos, 7 Risks to Retirement. This is an animated video book, 7 Risks to Retirement as you get close to or in retirement, some things to avoid and how you can avoid them. You can secure those by calling us at 800-725-7616, 800-725-7616, or going to our website, agemy.com, agemy.com. You've been listening to Financial Strategies with Andrew and Daniel Adjemi from Adjemi Financial Strategies because people don't know what people don't know. At Adjemi Financial Strategies, we believe that an educated retiree is a happy and stress-free retiree. Thank you for listening.
That's all the time we have for today. To speak with Andrew or Daniel off the air, call 800-725-7616. That's 800-725-7616. And for more information about Adjemi Financial Strategies, visit us online at agemy.com. That's agemy.com. We will be back again next week at this same time for another Financial Strategies with Andrew and Daniel Adjemi.